Today we're making a video on selling short the market. I want to stay long in my positions, but keep a hedge on at all times. So the SPY, we showed you on the chart that it's here coiling for a large move. We don't know which direction, but we're here on the 200-day moving average, the orange line, and we even broke the blue line recently, which I told you was a possibility, but if we did, we would probably hug it, and we have hugged it for the last few days. And we popped above the 10-day moving average, so that's bullish, and we're at a whole number of 400, so that's a psychologically key point. It's very important for traders. So we also have the RSI oversold here at 40, near oversold, and the mavg ready to cross to the other direction. The blue has to cross to the orange, just like it did here. It has to swoop down and out for it to begin its cross. And so it could begin its cross, and we could resume an uptrend from here. But we're right on the fence, and so you don't know what's going to happen, so it makes sense to use some insurance. So we'll go explore the 3 different ways to sell short. We'll look at selling short outright, buying put options, or buying triple leverage shorts. So really quickly, I just want to show you that the account's up 24%. Last Friday was up 20%. How did it grow 4% in one day? Because we got our dividends. So if you go to estimated income, you'll see that our income has grown, and because we reinvested those cornerstone dividends, so we're over 100 now. And I just wanted to also show you very briefly how we made money on the drip. So look, we got cornerstone dividends. So $650 that we just got for reinvesting the dividend of cornerstone, reinvested it at $656. The current market price is way above that. And we, because of the drip, last price was $8. Because of the drip, we got it down at $6, and it's an automatic $600 gain, 23%. So that's how the drip works with Cornerstone. That's why Cornerstone beats the other funds, because when you get the dividend, it drips it at the NAV, not at the current market price. I just want to show you that really fast. Anyway, so back to selling short. So SARK, SQQ, as you can see here, SPXU, 1,000 short. These are our triple shorts. If the market is down 1%, these will be up 3%. If the market is up 1%, these will be down 3%, because they do whatever the market does, but times 3. So you don't want to have too much in them because they decay. If you go to a chart of, let's say, SPXU, you'll see that it's been a losing bet long term. I mean, the market always goes up long term, but as you can see on a 5-year chart, this thing really decays. So you don't want to have too much of it, because it's just a losing bet over time. But when the market is dicey and you want to have insurance on it, makes sense to have some. So let's also look at selling short SPY. We just looked at the triple shorts. Let's look at selling short the SPY, because I got many questions on this on Reddit. So sell, okay, market, you just simply say sell short, okay? You want to do 100 shares, you go ahead and do that, 100 shares, market, preview. You just sell short, 100, market, preview, place. That would be it. I'm not going to sell short that many, but that's all you have to do. And then if you go to options, and this isn't going to be a too in-depth video. I just want to show you the basics, because I'm not an expert with options, okay? All I can tell you is that I use them from time to time when things look really dicey. Now would be a perfect time to have put options on. I just had put options on a week ago, but I was off on my timing by about a week or two, and I lost all my money due to decay. I only put $100 in, but I still lost it. I always lose when I do put options on the S&P, and I really wish someone was listening to this video and could give me better advice on how to deal with put options. During the entire 2022 decline, I had put options on, and they never made me much money. I made $1,000 here and there, but then I'd hold on to it, and then the market would rally, because that's how bear markets work. There's a lot of violent rallies, and I would always lose the profits on the puts. And if the market stayed sideways, then it decayed to volatility. You lose volatility, it decays, and then as time goes by, you lose to the time decay. So options are really tricky, but if you're on the fence like the market is on the 200-day moving average, like I've been showing you in past videos, then you want to own some options exposure as an insurance play, just in case things fall out from underneath you. So you just simply, when you do an option, SPY, buy open, let's say you want to do 30 days is the, typical time length to put on if you want good leverage to a down move, but not too much risk to decay. Because if you buy weeklies, yes, you get the most leverage in a down move, but they decay so fast that you better be right, or it's pretty much a losing proposition every time. So I like to do a month out. Most options people like to do 3 months out, but I'm talking that's on in general. When you're on the fence and things are looking as dicey as they are, you probably want to just go out a month. And then if you pick the right strike price, 400 is the psychological point below the current price of 404. It gives you a little cheaper option there, but they're still expensive. It's $600, $600 here for a strike price of 400. So if you're really thinking a real crash is coming, maybe explore the out of the monies at 370. Now they're much cheaper. It's about $100. They're 84 cents. So you could buy 5 put option contracts there for about $500 and get a lot of leverage on the S&P in a fall. Why am I not doing it? Again, because we're right on the fence and I lose with options a lot. So I just stick with buying the triple leverage shorts. They decay, but I don't keep too much money in them, and I don't lose too much money over time, but they let me sleep at night. They're not going to make a huge difference for me if we go down, but they are something that will help in the other direction and help me sleep at night. I just want to reiterate here that we are on the 200-day moving average. We said we would break the 100-day moving average possibly, and we did, but we still held it and we're hugging it. This is very constructive. The RSI is at 40. The MACD wants to cross. It's all looking like a setup for a bullish move. Now, the moving averages were far apart here and spreading out and falling. And here now they're starting to converge and move to the upside. These are all the things you want to see for a bottom. But again, I understand people's angst and the need to want to buy insurance. So that's how you sell short. I have about 5,000 short. You can go NASDAQ triple short. You can do Soxel triple shorts, Labu, which is healthcare, because I have these shorts on because I have puts on in the other direction that I'm bullish on. So I protect these positions with short hedges. But this is generally how you play a market that's right on the fence. You stay long like we are. We're heavily long. We have 200,000 long. 200,000 in margin, I'm sorry, and about 400,000 long the market. So we're extremely overweight the market. We're not going to sell out just because we're at the 200-day moving average. We waited out all the 2022 bear market, and we got paid while we waited, by the way, in these dividends. So we're not going to sell. We're just going to hedge with these triple shorts. The options I lose in every time, so I can't do those. But if someone has advice on how to do those better, please reach out in the comment section below. And then as far as just selling short, if you want just 1-for-1 exposure on shorting, you can simply go in SPY, click sell short, and you're in. But I prefer a little more leverage, either through using the triple shorts or through the put options. So I hope this video helps. If you have any more questions, leave them in the comment section below, and I'm sure other guys will be able to answer them for you. Thank you very much.